0.79%. Yeah. Mocking it. The market is mocking it. Listen, forget all of that for the moment. How are you? How are you? Listen, sometimes you got to wake up, look in the mirror, and ask yourself the most important question, which is how are you? How are you, Shaniqua? How are you, Ethel? Yeah, I haven't forgotten about you, fellas. How are you, Desmond, Fitzgerald, whatever your name is? Look in the mirror and ask yourself, how are you? Because at the moment, you could be thinking right now, the market isn't our friend. I'm losing so much money. Everything is dropping. But you know what? You could also look at it from the other perspective that the market is our friend. And it's actually the most valuable friend. It's the friend that disciplines you when you're not doing what you should be doing, but actually that's going to benefit you in the long run. You know, some people have got a whole bunch of yes men around them and everything that they do apparently is amazing to their friends, but you know what, you have that one friend that's like going to tell you that your shit stinks. And actually I think the market is doing that right now. I'm that friend. I will tell my people if their shit stinks and I'll be like, yo, behave yourself, pattern up, step your game up, you got to do what you need to do. And at the moment, the stock market, I think, potentially could be telling us off for our greed, telling us off for not looking at fundamentals, you know, for our lack of savings, lack of emergency fund, for getting into too much debt, all of the above. So listen, at the moment, I think we are learning a valuable lesson, and hopefully this is definitely going to benefit us in the long run. And in that long run, we'll be looking back and be like, you know what, thank you for this lesson. And actually, this is probably one of the best things to ever happen during our investment career. So yeah, I'm going to talk about top movers and fallers. I'm going to talk about my sector allocations, which is something that I haven't really done before in a portfolio update. So hopefully you guys will find that interesting. I'm going to talk about cash. Some people say cash is trash. Right now, I think cash is probably one of the best investments. And I'm going to give you my thoughts and feelings around that. And also what to do now. What to do now. It's kind of like Groundhog Day at the moment, but I'm just going to give a bit of a reminder about what I think, you know, some of the best steps that we can potentially do at this current moment will be. So if you want to know more, like, comment, subscribe, help the channel get to 5k subscribers. Again, a big thank you to everyone who subscribed to the channel and helped us reach the 4,000 subscriber mark. Instagram, Twitter at Infant Investors, follow, and you know there's a lot of posts on Instagram specifically. I share a lot of information and so forth. And if you are new to investing and you haven't picked a broker and you haven't started investing, my link will be at the bottom, freetrade.io/infant-investors. Click on that link. If you deposit £1, you will get a free share worth up to £200, and so will I, obviously. But obviously it can kickstart your journey. I just received a free share of Micro Hard, so thanks, Free Trade. And listen, we're just going to keep it rolling from this point onwards. Let's get into the top movers. The top mover for my portfolio this week is Imperial Brands. We can see that it's gone up 5.04% this week, and I think there's two key reasons why Imperial Brands has kind of been on the upward trend this week, which is obviously good. Maybe three reasons. The first reason is that there's been a lot of insider dealing. So we've talked a lot on this channel that insider trading is an important thing to look at for the stocks that you hold, because one, it gives you an idea of sentiment. I do believe that the directors, the board of directors, the CEOs, the senior executives, that, you know, they have to announce their share purchases. I think that gives a good indication into how they feel about the company. And obviously they're going to know things that we potentially won't know. So obviously that can be quite an important factor. So we hear, I'm reading this from Morningstar, that the non-executive chair, Therese Esperdy, bought $577,440 US dollars worth of American depository receipts in the tobacco company on Thursday, so very, very recently. For anyone that doesn't know what American depository receipts are, it's basically shares. So listen, if you are a US citizen and you're trying to buy foreign shares, you can't just buy shares, you have to buy these ADRs, which is American depository receipts. But I think apart from tax or some other implications, it's fundamentally the same as shares, so it's nothing to really look into. Also, Chief Financial Officer Oliver Tant bought 2,200 shares at £18.27, worth £40,000 in total. And then shares on Thursday closed up 1.4% on Thursday specifically. So I think that insider dealing shows a little bit of positive sentiment. The second positive sentiment for Imperial Brands that I believe is Moody's rating. So again, from Morningstar, Moody's basically have continued or maintained their Baa3 rating for Imperial Brands. So basically every stock has a rating from the agencies, Moody's, S&P, etc., etc., and it's basically an indication to the market whether it's like a junk bond, a junk stock, or it's like investment grade stocks. You know, you got the term AAA all the way down to like D ratings, etc., specifically with the S&P and so forth. Moody's basically has the same thing, but their rating system, their rating scale, you know, looks slightly different. But Baa3 is basically lower medium grade. It's an investment grade rating, and what that basically means is that they still think it's an investable asset. One thing that they've basically mentioned is that they believe that their cash flow will improve over the next 12 to 18 months, providing it starts to pay off its debt, which I think is one of the things that Imperial Brands is doing. Obviously, it's one of its big issues is that it still does have quite high leverage and high debt, etc., which might limit its progress. But as it pays that, it's going to obviously have more free cash flow, and it's going to benefit in the future. So I do think that that potentially also was positive sentiment. The third thing, which is maybe a 0.5 of the thing, I don't know if it's an actual thing, it's just the simple fact that the share has been beaten so much recently over the last month that actually a lot of retail investors probably think this is a good price, and maybe that's had some positive effect, but obviously I can't really verify or validate that. That's just something that I personally feel could be, you know, another reason as well. The second stock for me to go up this week is Centamin. Now the thing about Centamin, it's gone up 2.67%. There's not been any real specific news that I personally attribute to its rise. I think obviously you've got the fact that people are still hedging into gold, although, you know, we saw last week that people are selling gold to cover some of their losses. So Centamin was one of the biggest fallers last week as well. Over the month, it's gone up 5.77%, but you saw like last week it dropped at this like big drop, but now maybe it's kind of recovering again a bit. So I think that could be partly to play. There was some, you know, talk about, you know, Centamin has a big mine in Egypt. They're opening a second area where they're going to tender and letting mining companies bid. I don't think Centamin is bidding for that other area to basically mine. There was some talk about that, but I don't think that could be attributed to it. But I just think it's basically just a natural course of the market. A little bit of a correction, a little bit of a bounce back, a little bit of a hedge in play, etc., etc. But it's gone up, you know, a modest 2.67%, which has been good. And the third one to speak of is AMD. So AMD has gone up 2.38%, and I think the thing with AMD specifically is there's been again a lot of people, a lot of analysts, investment banks that have basically upweighted the price target for AMD. So some investment banks think, you know, the price target is going to be $60, $65, $62, $59, etc., which generally has a positive impact in the market. But I also think there's been a little bit of a recovery from the coronavirus situation. So I'm reading this from Market Watch. It says, at an Analyst Day presentation late Thursday, AMD Chief Executive Lisa Su forecast a long-term compounded annual growth rate of 20%. So a CAGR, compounded annual growth rate, is basically when you look in the past over the 5 years and you average out all of the actual growth that a stock receives. So maybe 1 year was 19%, maybe the next year was 100%, maybe next year was down 100, whatever. It's basically what is the long-term compounded annual growth rate, and basically she's forecasting 20%, which is an impressive forecast given the company's CAGR has been in the mid-teens over the past 5 years, and the stock has been the S&P 500's biggest gainer in both 2018 and 2019. Sue also said the company's supply chain was also back to near normal capacity amid disruptions from the COVID-19 coronavirus. And I think that for me is probably the most important part of it, that obviously their supply chain would have been affected, would have been hit with the whole coronavirus situation, you know, the production, the distribution of their chips, etc., the manufacturing of the chips and so forth. So because of the disruption, she's basically saying that they're near to normal capacity, normal operating since then, and I think obviously that's going to be quite an important factor. So I think maybe that's had a little impact in the share price rising for this week. Fundamentally, those were my only 3 stocks in the green this week. In terms of this week's 7-day performance, everything else is in the red. So let's get into the top fallers. The first one, Virgin Moolah. Virgin Moolah has gone down 12.08% for me. I think there's 3 reasons personally that Virgin Money has gone down 12.08%. So I think the first thing to talk about with Virgin Money is job cuts. I've always said this. I personally believe that job cuts is always going to be a negative sentiment in the market, and I think it's going to have retail investors basically, disappearing. So I'm reading this from City AM, and basically says UK bank Virgin Money is planning to cut 500 jobs as it continues to integrate with Clydesdale and Yorkshire Banking Group CYBG. It said today. The Challenger Bank also said it will shut up 52 branches. Of these, 22 will be closed this year and 30 more will be consolidated into another Clydesdale Bank, Yorkshire Bank or Virgin Money location within half a mile. I think anytime job cuts are announced is a bad thing in the market, but I think that's partly a bit of a temporary negative reaction. I think if you look at the long-term fundamentals and maybe the operating expenses and how much they're going to save and reinvest into more profitable areas, that obviously from an investor standpoint potentially is a good thing. But there is a consumer investor conflict. From a consumer standpoint, it's always sad to see people losing their jobs. From an investor standpoint, then there's a potential to buy the share at a discounted price. I do think as well, we talked about terminology in one of the previous videos. I think terminology is also important in this context, because when we say job cuts, we're actually saying family income losses. And from my time working in the bank, seeing people that have experienced job cuts and how bad it's impacted certain families, it's never ever a good thing. And so obviously it's not something to really see as gleaming from ear to ear from, because it's something that I don't like to see. But obviously, I think there is a conflict, as I say, from an investor standpoint. And so that is, you have to, if you are investing into a business long term, just potentially see this as an opportunity. The second thing rather, is the Fed rate cut. Now, you guys know that the Federal Reserve had a impromptu rate cut, which is basically to try and stimulate growth during the whole coronavirus situation, which I believe obviously was a hasty decision. I think they didn't really need to do that, and I think what it did is actually set more shock in the market. Now, obviously, the Fed rate cut in America is not going to literally directly impact the UK banks. However, I do believe what it will send is a message that the Bank of England maybe might follow suit and do a similar thing, and I think investors might believe that. And if they believe that, then obviously they're going to potentially be pulling out. So I think that Fed rate cut has had a negative impact in the US for sure, and I definitely think it's potentially going to have a negative impact in the UK, where typically it should have a positive impact, but I think at this time it just wasn't the right thing to potentially do. And so I think that's another reason. And obviously I still think it's still feeling the effects from the whole coronavirus situation as well. I think that's, I don't want to talk too much about that, but I still think that's something that's obviously worthwhile in just mentioning. That is obviously going to have an impact. The second stock that's my second worst performer is Lloyd's. So Lloyd's for me this week has gone down 7.79%, and you know what, I think it's pretty much the exact same reasons. Job cuts. We know that Lloyd's has made 780 job cuts. I think they're not closing branches, but they've announced 780 job cuts as well, which I'm reading from the same article. One thing that I've seen in one of the Lloyd's articles, it basically, I'm going to read this from The Guardian, and I'm going to give you my thoughts and feelings on this. It says the Lloyd's move is expected to affect customer advisors, banking consultants and bank managers at its Lloyd's Bank and Halifax sites. Managers at its Bank of Scotland branches will also face cuts. The job losses are expected to be completed by October, although no branches are expected to close. The announcement comes days after the bank reported a 26% fall in annual profits to 4.4 billion and confirmed that it was cutting its group bonus pool for the first time in 4 years. Lloyd's blamed the decision on changing consumer behavior and increased use of digital banking. You absolute bastards. Yeah, you're chatting S. I do not think that you can ever say changing consumer behavior and digital banking is, the reason. If for me personally, digital banking is not new. Let's just be clear. I think digital banking, online banking, has probably been around for, I would venture to say, 15, 16 years, maybe longer. So if it's been around for that long, I think that you should really see that as you should have been at the forefront of that whole digital banking revolution and digital banking change. And you can't be blaming that 16 years down the line and saying, consumer behavior has changed. No, I think that's a very weak reason. It might be the reason to not have branches, but it's definitely not the reason to be falling in profits or whatever, from an a year-on-year perspective. It's still obviously made a very significant profit, and especially if you strip away the PPI situation, but obviously it's not as much as maybe the year before, etc., etc. So I think that's a bit of a weak excuse, a weak reason. I'm reading this from the Motley Fool, which basically talks about, is Lloyd's a buying opportunity? And this specific writer says that he thinks the Lloyd share price needs to reach 40p, and once it reaches 40p, that's his buying price, and that's where he thinks, once it hits that level, that's when Lloyd's is definitely a buying price, which is interesting. I'm going to talk a bit more about that later on in the video. And I also think, similar to Virgin Money, the whole coronavirus situation has definitely affected Lloyd's as well. Now, the last one to drop is Micro Hard, and that's basically dropped 6.49%. And again, there's no real reason for me. So when I really look at the broader graph and the broader picture, I think obviously coronavirus has played an impact. But I think with some of stocks like Micro Hard, which basically did very well over the last year and so forth, it might just be, a bit of an extended correction from their perspective. Obviously, a correction is like 10% or more, and I think what, people are probably taking profits off the table, maybe putting it into other stocks, maybe putting it into cash, etc. I said to you in a previous video that if it can hit the 135-ish to $135 mark, for me, that's going to be my buying price for Micro Hard. And I think that at that point I'll definitely buy another round, and obviously hopefully it will grow again in the future. So obviously I can't do anything at the moment because I've maxed out my ISA, so I can't actually do anything, and I have to sit and wait, and we'll see what it is in April the 6th once I'm able to reinvest into it again. So next thing I wanted to talk to you about was my sector allocation. So what you can basically see here is what allocations I have in terms of what industries, and what it basically looks like. So you can see 28.2% in finance, tech 27%, which makes sense because those are the two industries that I probably tend to favor and like the most, I would say. Property, other, so forth and so forth. Now, the important thing for me is that when you go to type here, you can see I've got 96% in stocks, which makes sense. Bonds 3.7%. Obviously I've got a monthly paying bond. Commodities 0%. For those of you that are wondering why I don't have commodities, I've explained it on multiple occasions. I prefer to buy gold businesses or commodity based businesses rather than commodities itself, just because there are other factors such as dividends, such as earnings, such as opening other business units, such as share buybacks, such as all of the other equity based factors that can have a positive impact on stock performance, rather than just having a piece of gold, etc. So that's my personal preference. That's why there's no commodities, but obviously I do have gold miners stocks, which I consider my commodity exposure. But you can see cash here is 0%. Now obviously it's 0% because I have 24p sitting there, but actually I think the broader question for me is how should we start looking at cash? And it goes into my topic about how important cash really is. Listen, I know Free Trade are listening, and I think one of the things I would definitely recommend or like to see, probably not a priority, but at some stage, is a cash part of the portfolio where you can actually invest in cash and actually earn a little bit of an interest rate. I don't know what the interest rate will be, but I think there is an opportunity to do that there, because what, cash is an investment. It is one of the 8 asset classes. Typically in bullish times it's considered one of the worst investments, which is why you have people saying cash is trash. But in bearish times like this, it's probably one of the best investments. Rather than getting a 12% loss on Virgin Money, you could be getting a 0.5% growth just by leaving it in cash. And actually then when things start to recover, or maybe when things start to converge and is actually going on an upwards trend, you can then take that cash easily from this account and move it over to your stocks, and then obviously start investing into whatever opportunities that you actually see is important. So I think that's a really important thing to do. But I think more broadly speaking, irrespective of whether a free trade is going to do that or not, just more broadly speaking, that what people should definitely be doing and what people should be thinking about. I've always talked on this channel, probably in the the video about what's that video called, the one how to invest £100 or whatever, how to invest £250, you need to have your emergency fund in place, 3 to 6 months expenses. You should be saving cash and have a cash target figure. It could be 10%, 20%, 30%, 40% of your portfolio. So broadly speaking, you should be having, if it's 40%, then whatever you've got in your stock market portfolio, you should then have 40% in cash. That's if that's your figure. You know, it's up to you to define what that figure is, but you should obviously be saving cash. And I think that, you know, is an important factor, so that when the market is falling, you can then deploy that money and obviously take advantage of those opportunities. And, you know, we talked earlier on about price targets, for example, and if you have a price target on your stocks, I think if you don't have price targets on your stock, I think it's something that's very wise and worth doing. You know, you should be looking at your stocks and be like, you know, Aviva, I think my price target for Aviva is £3.15. I'm just making it up. And that way, rather than just reacting and just buying now, maybe it's worth saving some cash up, and when it hits £3.15, if it hits £3.15, you can then deploy whatever it is you feel it's worth deploying. The guy in Motley Fool said 40p is his price targets for Lloyd's. I just mentioned my price target for Microhard is $135, which is about £100. So ultimately, I think that's potentially a wise thing to do. But the only reason you can be able to take advantage of those price targets, etc., is if you actually start to store up some cash and to store up you know, some of that. And I think that's probably a very safe thing to do, a safe way to react to this current situation. You know, it's all about controlling your emotions, not panicking, and obviously, you know, investing in the opportunities once they present themselves. For me personally, as you guys know, I can't invest in anything until April the 6th. There has been a lot of questions recently about, you know, how does the ISA work again. I think I've explained it quite a few times, but just for the avoidance of doubt, once it hits April the 6th, within the same ISA account, I can put another 20k in. Simply put, that's basically how it's going to work. And obviously, I will start investing at that point. But at this moment, I've just got to sit the game out. And I think it's given me the opportunity to actually just take some time out of the market, save some cash up, just analyze what's going on, analyze what stocks I like to invest in, what opportunities there are for me. And so come April the 6th, I can then obviously start executing against, you know, whatever that plan is. That's all for today, really. Done a lot of videos this week about a whole bunch of stuff. So go check out the channel for more investment videos. There's a lot more to come this coming week as well, so look out for that. And yeah, have a great weekend. You know, forget about the market. You know, Monday will be coming very, very soon, and the market will be opening. And next week, I guarantee I will be reporting to you that I'm in a loss. I can feel it. I could just feel it, because 0.79%. You know, I went from 17% to 0.79% in the space of 3 weeks. So, you know what? I know it's coming. Next week I'm going to be at a loss, and it is what it is. I can't do nothing about it, and I'm just going to sit there, hold tight, save my money, and come April the 6th, you know, continue as normal. Hope you found this useful. Like, comment, subscribe, and I will catch you next time with another investment video. Take care, guys. Peace.